What is going on, everybody? We're back. Lead Maxer, Nigel with Zach. Say what's up, Zach.
What's up?
Yes, sir. All right. And today we're going to be extrapolating on the different strategies of real estate investing in the year of 2026, and specifically in July. So the average rates right now are around 6.3 to 6.5 to 6.8, sometimes into the sevens, depending on the products that you use. So that's kind of what we're basing off of. And this obviously is going to change depending on what year we're in, even in some cases, what month we're in. So what do you got to say, Zach?
Like we were discussing before, it's not going to be a one size shoe fits all type of solution when it comes to picking a product for whatever, um, you know, ambitions you have or projects you have in mind inside of the game of real estate. I think everyone has a common goal of trying to make money with applying the correct product for the correct scenario and trying to maximize the amount of profit you're going to make when it comes to either holding on to a property or selling it and moving on to the next one. So that's the basic gist of this today. This is not an exhaustive list, but these are just some basic topics that you should be familiar with, so that when it does come time, you have the money available, the funds, the qualifications for the loan. These are terms you should be familiar with in order to hit the ground running.
Yeah, and especially plan for the future, because as many times you hear people say you got the rest of your life ahead of you. I 100% agree with that, but making proper decisions, especially applying the correct strategy, can save you a crap ton of time, and really get you from point A to B to C to D, all the way to Z, a lot sooner than the next person who's got the wrong strategy applied. And also knowing when to switch your strategy based on the market you're in, which applies differently through each state. So everyone take this with a grain of salt, and don't take it too seriously, but also listen along, comment down below, and join our Discord if you guys want to share your insight or share videos of sales calls, etc. We'll address that later, because this video really pertains to our opinions, and that's exactly that. So let's take it away, Zach. What do you got for us for the first program product business strategy?
All right, so we have, as you can see behind me, a ranking here between S to D tier. I'm sure you guys are familiar with this kind of list, but the first product we have on the list is BRRRR. Stands for Buy, Rehab, Rent, Refinance, Repeat. Okay, so the main gist is you buy a distressed property below market value, or even just any property that you can add value to. Fix it up, you do those alterations for it to add the value to it in any way possible. Ideally, you had a plan for that prior to picking the property.
Yeah.
Then you rent it out, and then you refinance to pull your cash back out of it. So you can take that cash that you pulled out and put it into the next property. So it's basically a very quick way to add velocity to your capital and keep recycling the same capital that you started with, rather than locking it up in a property long term.
And I think a huge pro to this, just so we can really kind of water it down, is this is one where we're going to see the ability to sort of force appreciation through that rehab, instead of waiting on the market or waiting for you to build up equity to then strip out the cash. That rehab part is really pivotal and probably the hardest part. I think anyone would agree to that, but just for
Yeah.
people that know nothing about this, the rehab is where you're going to see the most risk, and the rehab is where you're going to force the most of that appreciation to be able to hit that repeat cycle. And that's again why it's so famous. So Zach, where are you throwing this, or where would you want to throw this? Because I know where I would, and we can kind of meet in the middle here. Um, and I'm fine with going first. You let me know.
I think I would put it maybe not S tier, just because there is a lot of risk involved with growing a portfolio rapidly with the low amount of equity relatively. I would go B tier, in my opinion.
So I like where you put it, and I'll let you extrapolate. I'm feeling C tier, and here's
C
why.
tier.
This one is one of my favorites. I really do like it, but it's so market oriented, and this 6% mid sixes rate, or even if it's a DSCR purchase, depending on how you're purchasing it as well. If it's DSCR, you're almost tickling the sevens, which is what a lot of people are using right now to get into investment properties. Again, if you're getting into some, savvy, seller financing, if you have that ability to spend that amount of time sourcing deals to find yourself a property where the seller's going to give you the property with, way better loan terms, this climbs up for me. But realistically, for most people, I call them average Joes, but for a lot of people, up to probably 90% of people doing BRRRR, I feel like this has fallen from grace because these rates are really killing the amount of income that you're going to bring in, because that rent roll is really not covering as much as the, cost of the mortgage with taxes and insurance and all that stuff. So I think it's C tier strictly because of the market. I'm not going to go less because it's something that's tried and true. But again, we're talking about the most important part of the BRRRR, which is the rehab portion. The market makes it just everything a little bit more anxiety driven and strenuous. Where if the rates weren't as terrible, home values weren't as high as they are already in a lot of states, especially in the one that we're in, the BRRRR
Hmm.
almost doesn't even exist for guys like you and I in the state of Rhode Island,
Yeah.
because these
Yeah.
properties, there's such a high buy-in price, even at 20% equity with the
You're carrying
DSCR.
just such a tremendous amount of risk. And another thing I'd like to add is, you start getting into territory where you're needing more and more individual loans to continue your strategy. So you're extremely dependent upon, like Nigel said, the mercy of the market and the bank, your relationship with the bank.
I think it's still C. The only reason is if it's a strategy that's going to be built on rehabbing it, then refinancing it, it's really only going to work on paper if that post rehab appraised value creates enough of a spread to survive the 6.5% interest rates. And most deals that were penciled in from 21 to 23, uh, those rates, those kind of rates back in 21 to 23 were amazing. It makes total sense then, but those kind of deals simply die in today's market. So, and then not to mention, you're taking on a rehab risk twice over with cost
Yeah.
overruns, contractor reliability, appraisal risk, and for a payoff that's shrunk considerably just with that market change. So that's my word
And
vomit on the case. That's why I think C tier, but I'm fine with
okay.
I'm fine
Can we,
with.
can we agree to leave it here, or you want to move it down?
I think for the sake of the video, it's fine. I think everyone knows our opinion, and I want everyone to know that wherever we place it, one up, one down, it's not the end of the world. You guys just hear what we're saying and take it in as to how how you'd like. So I'm
Nicely put.
fine with keeping it B for sure.
All right, next one on the list is a very classic one. It's tried and true. It's going to be buy and hold. I'll put this over here for now. I'll just leave it in B tier for now. What do you think about that one, Nigel?
My ultra instinct with buy and hold is A. I find buy and holds to be the least flashy, but appreciation plus amortization compounds regardless of rate environment. So if you can stomach thin cash flow today and refinance later if rates ease, it's not S tier, but for me, it's certainly A tier. Um, and again, I think you're kind of buying the promise of the future appreciation and a future refinance, not an immediate income. So that for me is real estate investing 101 to the degree of, you're building
Yeah,
yourself up a portfolio.
exactly. A lot of these things are market dependent, and but there is no, like Nigel said, there is no replacement for time in a market in any investment. So over time, you will win. It's just a matter of what your risk tolerance is and how long you want to hold on to something.
Correct, yeah, for sure. So what are you thinking, tier list wise?
I agree with A. I think it's not flashy, like you said. It's not flashy at all. It's not going to get you rich overnight, but that shouldn't be the goal when you're setting out. It should be to be wealthy long term and financially stable. You do want to hold on to most of the real estate that you buy, whether you want to strip it of equity and continue to buy quickly, like we talked about with Burr, or hold on to more of the equity. You're going to be doing some format of buy and hold, but at least with a couple properties. Whether even if we'll talk about flipping coming up here as well, but even if you're going to be flipping in the flipping mindset of just buy, move on to the next one, you're going to be needing to hold on. You're going to be wanting to park some of your money in a property for the tax advantages and rental income advantages alone. All right, and then the next one we're going to talk about is going to be fix and flip. Yeah, for me personally, Starting out, I think it's I think it's up there with another one that we'll talk about, house hacking. I think I'm going to put that S tier in terms of sheer amount of capital that you're going to generate in a short amount of time. And you might disagree with me, Nigel. It is one of on the riskier side,
Yeah.
but I think let me preface this part with this to begin. If you know your market very, very well and you're comfortable with your market, and maybe your close family member is a real estate agent or someone else is a real estate professional or you yourself are one, I think this is really the strategy to pursue when you're starting out. You can be extremely successful with this strategy. This is going to involve a lot of research, a lot of homework, and you make most of your money when you buy it. There's only so much you can do in terms of adding value, forcing appreciation to a property, and you want to be careful not to price yourself out of the price point of a neighborhood where you're adding way too much money to a property where you're the nicest house in the block. I don't think I would ever want to be the nicest house in the block, relatively speaking, or people who want to buy a home that much for that much money that you now price the home at would be looking at a different neighborhood.
So, for a lot of the reasons that you said that I won't repeat, I believe I would slot this in closer to a B tier. And the reason is being really educated on the market is a lot easier said than done. This this fix and flip ideology is something we also see a lot online, and I think it's a little bit shinier than people kind of make it out to be. And the reason why I think that is it's definitely still viable. B tier is not a bad tier to be in. But hard money costs plus longer days on the market from this rising inventory that we're seeing, it squeezes margins. And when there's squeezed margins, it's a miserable life to live. And you and I have experienced that before.
Yeah.
It drops out of A because it was a close one for me in A, but it drops out for me from A specifically because holding costs are they're financed at elevated short-term rates while you're exiting the sale, and it's
Mhm.
happening in a slower market than flippers got used to. Very possible, and like I said, with the viable correct operation and operator, it definitely works with intense knowledge in the market around you and an ability to let go of things. Like seriously, I think this is one of those operations where you have to be prepared to pile of cash in the middle of the room and burn it. And if you're okay with that being burnt, then I'd say go for it. So if you have a emergency fund, a business emergency fund where something can go wrong, then I think that there's really high upsides to this, but there's also really low downsides to it. And again, I think it's specific to that the holding costs are brutal when you're financing, especially with hard money costs. We have some experience lending money out, and when things go past that threshold of time, and as inventory rises up, it can be it will literally keep you up at night. You know what I mean? And if a project's
Yeah.
just
So
taking
it's
way longer, it's like, oh my gosh, get me out of this.
holding costs are one thing that will eat your profit entirely on the fix and flips. That's one
Yeah.
thing you need to really be cognizant of. I
Mm-hmm.
think one of the saving graces of it is a 1031 exchange. Everything that Nigel said is correct. You're going to incur a lot of expenses when you're preparing to sell a property. But the saving grace is when you go to sell, as long as you identify a property within a certain time period and basically elect to use all the proceeds of the sale towards the new property of equal or greater value, then you're not hit with capital gains tax, and that's a
Yeah,
huge thing
it
to,
is.
to be able to avoid and to add more cash to your capital to continue to grow your portfolio, to continue to grow your income. So it's a huge thing to pair with fix and flip. So I just threw that in there. You can
Mm-hmm.
you can 1031 exchange with any of these really if you're going to sell it, but primarily it's going to be used for value adding, selling, and trading up to the next asset. So it pairs very well with fix and flip.
We got to figure out a way to place this because you and I are quite far away. I'm fine with dropping fix and flip to A tier. I'll meet you in the middle.
Okay. You were saying B tier
I was
initially.
in B tier, so I'm fine with
All right.
dropping it to A, and we'll
I'll
meet you in the
agree.
middle. In the
For a
middle.
risk based
And are
basis,
we
I'll put
keeping
it there.
1031 because that's not
Yeah, I'm gonna
really.
keep that up there.
Yeah, I mean, it applies to a lot of the things we're talking about too. Well, not a lot of things, but a few of these things we're talking about. So we can keep it there. What do we got next on the list, Zach?
All right. Next one is house hacking. I know exactly
Mm.
where I'm going to put this, and this is probably,
I
in my
I know where
opinion,
I'm gonna put this. Yeah,
I think it's the best possible thing you can do as a
we agree.
beginner starting out. So I'm going to
I
put it right
agree.
at S tier. It's S tier for a multitude of reasons.
Yeah.
There's a tremendous amount of tax savings that can be had from living in a property. House hacking in general just means that you're buying a home with more than one unit in it. Typically, to
Hmm.
begin, it's going to be a duplex home, meaning a 2 unit home,
Right.
just because they're on the more affordable side of multi unit families. Obviously,
Yep.
multifamily properties. Obviously, as you start going up 2, 3, 4 family units, the property is going to be larger and they're going to require more expensive. And they're going to require more of a down payment. Typically, a house hack, the most common one I see is a duplex, where you're purchasing a property where there's a lot of times a renter already in place in one of the units, and then the other unit is a unit that you yourself are going to house hack into. You're going to move into and live in.
Right.
And so, in doing so, the whole purpose of this is to basically subsidize some of your own living expense
Hmm.
by utilizing the income that's coming in from the tenant that's in the other unit. So the tenant in the other unit, ideally, it's a lot harder now today, like Nigel was saying, with as interest rates have climbed up a little bit to get this scenario to play out perfectly. But ideally, you'd like to live in a spot where you're at least breaking even to live somewhere, and having the other tenant pay down your mortgage. In the new reality that we find ourselves in people our age looking to buy their first home in their early to late 20s, this is one of the best ways possible
Right.
to save on the costs of associated with buying a home, as well as set yourself up for the future. If you really take advantage of this, there's so many different benefits to it. There's a tremendous amount of tax benefit to it, and the
Right.
fact that, um, if you're living in one of the units, the entire property itself is technically considered your primary residence. So you have, the ability to claim your primary residence homestead exemption on your property tax.
I think that owner occupied financing is just something that sidesteps that investment property rate premiums. And that alone makes it not
Mm-hmm.
only much more obtainable for the everyday person who really wants to get their feet wet in property investing. This is in my opinion, the least risky way of doing that. And realistically, it's just a way of doing it with reduced costs, but you're still getting that investor edge of collecting income in a way that's helping you pay down the
Mm-hmm.
mortgage almost completely. And if not completely, a significant amount, which is a blessing. I mean, we all want low mortgage payments. So I think a con, if I had to throw one in there, is you're limited to that 2 to 4 unit properties, because
Mm-hmm.
anything greater than that, then it goes. Well, I
To a
don't actually.
commercial
It
loan,
does go to
right?
commercial loan,
Yeah.
yes, but actually, because you can do DSCR past 4 units, so I don't know if it's classified with commercial. I just think
It's
it's
just
an.
a I
I think it's
my
just an. I
understanding
think it's just an FHA code that you can't
my
go past two to
understanding is
four.
my understanding is past 5 units, it's still you can still do a DSCR, but the interest rate is just significantly higher
That's true.
as a result of moving into commercial
But
territory.
for the most part, in terms of how the FHA regards and labels, I actually remember this from our test that we took when we passed the
Yeah.
NMLS exam. Anything greater than 4 properties, RESPA doesn't get involved, and I think ECOA might still. Whatever. My point is you're in a different bracket, so that's the only con to this. And then also it is a slow burn, a scale. It's a scale slowly. You can only really house hack one property at a time because it is your owner occupied
Mm-hmm.
owner occupied. I just want to again glorify that it's the best risk adjusted entry point in this rate environment. So today house hacking
Mm-hmm.
is S tier. Tomorrow BRRRR could be S tier. But it's the fact that we are literally sidestepping almost entirely what the investment property rate premiums are, like I spoke about. You're also sort of operating completely regardless of what the Fed is doing next, which is a blessing. So nothing below in the tier list really comes close because every other strategy is relying on fighting the current rate environments or
Mm-hmm.
fighting regulation, which is another thing that we'll get into the other tiers because
Yep.
regulation is a huge deal breaker for some of these placements that we're putting in here.
I just wanted to add as well, you could also pair this with down payment assistance as well, depending upon what state
Income,
you
of
live in,
course.
and income that you have as well. Yeah, so it could be a great way to get into a property with relatively nothing out of pocket and start
Yeah.
building equity
Not to
faster than
mention,
almost anything here.
not to mention, if you have a great realtor who's really hitting the ground and you have a good realtor that's bargaining
Mm-hmm.
for you, you could really walk out with almost, no cash out of your pocket, depending on the contract that you signed. So, yep.
So on that note of sidestepping the current market
Hmm.
environments, I want to just mention this next: seller financing.
Yeah.
Um,
Whew.
where would you put that?
Seller financing is something that if you can do and you could scale, and we actually, and I'm not going to get into this deep, but Zach and I, we kind of peered into a whole hub or group of individuals that were partaking in sourcing seller finance deals. Um, and it's definitely a grind. So it's S tier for me if it happens for you. Thinking
Yeah,
of one individual doing it, getting in and finding a property where they're basically saying bye bye to the interest rates, which are the biggest problems other than home prices and home
it's
values.
yeah, it's an
It's,
extremely time intensive process.
yeah.
But if you do have the time to dedicate to it, it's something that eventually will pay off. Like Nigel said, I think there's two most common use cases for it. I might add
Hmm.
one more to what he said. It's going to be your immediate family members that are going to be your first go-to for this if they're comfortable with it, and then the
Hmm.
second option is going to be maybe that it's the same family member, but somebody who's just has a inability to consider any other price and might be way overestimating the value of their property in the current market. It's a way to pay for property above
Hmm.
asking price in a lot of cases.
Well, that makes it
Just by
also
demanding
competitive. Yeah.
exactly just by demanding more favorable terms, and it doesn't
Hmm.
require the same. The reason why it's S tier, I think, as well for you, Nigel, is it doesn't require any real qualifications other than a
Yeah.
written
No
contract
underwriting,
between
no
a
mortgage
buyer and a
rates.
seller.
It's
Correct.
amazing. This seller financing is literally its own beast. But to wrap it up, I really think, to make sure, because I didn't really introduce it simply. It's just when the buyer and the seller negotiate that rate, they negotiate the terms, so down payment, amortization, balloons, um, and it can be structured really creatively, and it's really
Mm-hmm.
good for sellers too, and they don't often understand this, and especially because if the seller's working with a realtor, the realtor often doesn't like it. It sounds scammy to them, number one, but also realtors are worried about them getting paid, and they assume that that's not part of it, which
Yeah.
it can be, but we'll get into that in a different video. My point is, though, is it's actually a lot better for sellers than people think if they own that property free and clear, and they
Mm-hmm.
want income plus a tax deferral and buyers who can't qualify traditionally. And that is huge. People don't
Correct.
understand. And people are putting their houses on the market. And obviously, this changes per state, per market you're in. But a lot of houses, if you're going on Zillow and you just are in this real estate world, properties are sitting for a long time these days because people can't qualify. Income has not gone up as a standard, but property values, interest rates, all of these things have skyrocketed,
Mm-hmm.
maybe not skyrocketed, but especially after the 2021 collapse of rates and now going and sitting steady for year after year after year, I think for the first time we've seen there is more inventory than buyers. I read something about that. Maybe I'll pop
Yeah,
up a screenshot of that.
especially in states like Florida.
Right. And my point is this is so big. Sellers listen. If someone's actually can sit with you and structure something like this, it really can be beneficial if the flexible terms are there. Seller financing is S tier. I don't think it's above house hacking, but I think it's very close because this is also something that it doesn't matter what's going on with the Fed. It doesn't really matter what's going on with mortgage rates because it lives outside of that. And also, if you can get a deal together, everyone's on board, structured, all good, flexible terms are all listed out, everyone agrees, we're talking about something that can close really quickly. Let's hit up the next one. Let's get through
All
these
right.
babies.
So we just have a couple more. I also had wholesaling in here. That's kind of in the same vein of seller financing, so we'll leave that there for now. Wholesaling is the flip side of seller financing. It is basically you, let's say me or Nigel, found somebody who is a FSBO, a for sale by owner, selling their property where they have maybe a fully paid off home or a tremendous amount of equity in it. I think it's typically greater than 80% equity or more. It really becomes a good candidate for this. But wholesaling, really just putting a property under contract without the use of financing from the bank. It's using the equity in a home that a seller already has baked into the property, and they become the bank financing the property to you versus having to go to a bank and qualify and go through the whole application process and get qualified up to an amount. There is no threshold that they can qualify somebody for. But anyway, you as the wholesaler, you're just the middleman. All you're doing is calling the seller of the property that you identify that has a lot of equity in it, and you're getting them to agree to sell the property at a certain amount. Okay. And then from there, what you're doing is going and finding another investor to purchase the contract that you already have. So you're selling your right to purchase the property to someone else. And you may say, why would even anybody ever do that? Can't they just do it themselves? Like we mentioned, seller financing is a tremendously time intensive process. So a lot of these investors their time is better spent managing the portfolio they already have. So they would much rather just pay somebody a commission check to go and find a property that has the time, but maybe not the money. So that's how that
Yeah.
typically goes down.
So for wholesaling, I think we have to dock this to A tier simply off the fact that you're contracting a deal and you're assigning it. You're not actually buying it. It's effectively a sales and marketing job. You're wearing a real estate costume.
Mm-hmm.
You know, and I think another huge con why I drag it to S tier, or excuse me, to A tier, is because it's legally gray, especially right now, or restricted in a lot of states without a license, and it requires a really strong lead gen and really strong negotiating skills. And it's something that, it's a skill set that most people vastly underestimate. I mean, we see a lot of people calling on
Yeah.
wholesaling. We actually know a lot of people in wholesaling, and it is
Yep.
not for everybody. I would almost even put it into B tier because we're looking at, I think, the peaks of all of these things. And when you look at the peaks of all of these things, it's easy to romanticize and throw these up really high, but wholesaling is also a really saturated market, and people who are selling their houses, you'll get a call. Everyone's going to get a call usually from a wholesaler because that's what wholesalers have to do. So they've kind of created a sort of outline of who they are in the world today, which when you pick up the phone and you get to know that you're talking to a wholesaler, it sets you down. And that's why it requires you to be so informative, explanatory to the person that's
Mm.
selling their property. Because, if you're not capable of doing that, then you're going to have a hard time. Again, reinforcing what you said, the good parts, no capital required. It's really about, it's really skill building. It works in any rate environment, which always
Mm-hmm.
sends these things up high in the tier list for
It
me
actually
because,
prefers
yeah,
higher rate
right,
environments as
exactly. Which
well.
is,
Yeah.
you could really build a business off of wholesaling. You can drag some young guys in, teach them well, scale this up if it's what you want to do. Um,
Mm-hmm.
you never really are building equity here, so I find it to not really be investing. It's really deal finding. So for me, A or B tier. Almost even tempted to throw it in B tier because
Yeah, I
we've
think
played
it's
around with wholesaling, and it sounds a lot better than it is.
Yeah, it looks great in a YouTube ad, and that's why it's heavily marketed. And a lot of times, the people doing it are making most of their money off of selling the
Mhm.
knowledge behind it as well. They're selling
Right,
a course behind it.
coaching it. Right.
Exactly. So they're building up a community of people that are paying an amount to learn the skill. And
Right.
with a lot of things, that's beneficial to do so. There's
Hmm.
school communities, there's other communities that are really beneficial, but I mean, when it comes to something as overly saturated, like Nigel said, with this, that doesn't have a license requirement, that doesn't have anything else involved with it, you're going to run into a lot of roadblocks when it comes to actually pulling this off. And you're competing with people who have been doing it for 10,
Yeah.
20 years already that knew about it prior to it being publicized. So if you
Let's dock
don't
it to
have,
B.
yeah, I would
I
bring it
think we
down a
do.
little bit. I would
Yeah.
put it in the same vein as fixing and flipping in terms of just the sole goal or purpose being to generate capital quickly. But
Quickly.
it's
Hmm.
it's It's not going to be as quick as fix and flip, but it's going to be certainly a lot less risky.
Hmm.
If you don't have any capital at all to start, I think wholesaling is a great thing to learn. Along the way, what you're mostly going to get out of this um, is the knowledge behind real estate.
What
All
do we
right,
got
then
next in
we've
the
got a couple
pipeline?
more timeshares.
Yeah.
I'm
We'll put her in D tier
I'm
for
gonna put
me.
D tier. Yep.
It's
So
not even an
time.
investment. I don't really, it's on this list. I wouldn't even almost rank it as one. It's dead last because it fails the most basic test of an investment, which does it build equity? Hell no, it doesn't. It depreciates the moment that you sign, and
Yeah.
there's really essentially there's no really resale market. I mean, we see plenty of them selling for $1, and you still can't even find a buyer. And that annual maintenance fee climbs every year, regardless of whether you use it.
Yeah.
It's a consumption purchase, marketed as an investment, and it's the one entry on this list where I feel like it's not even almost good enough for the
Definitely
worst here. So
glad we agree on D tier
yeah,
there.
yeah,
It leaves you at the mercy basically of a decision making owner, and you're not going to typically be a part of a committee unless you're a part of a small decision making board that they
yeah.
typically extend to their friends or close family that run those type of things. So I would be very
Hmm.
wary of it. As a consumer though, maybe there's an argument to say, yeah, I mean if there's a real remote part of the world where there's just extremely expensive hotels or
Hmm.
vacations, yeah, it might be worth it for if you want to split it with a friend or
Yeah.
group of people that you
It's
really
also good for
trust. Maybe
time
for
blocking when
yeah.
you want to go out yourself. You can't call yourself an investor. You could definitely utilize one if it's something you enjoy, but to categorize it as investment, to actually bank on it, I'm sure
Yeah,
there's some
no.
successful people doing it, but I highly doubt it.
So the next one, it's short-term rental, STR.
Yep.
I'm gonna put this B tier personally.
Ooh, I had it in C tier,
Yeah.
and I'm kind of not budging. Here's why.
Okay.
So to me, it has a high ceiling, but there's a lot. Here's where we're talking about regulatory
Yeah.
risk, and
Yeah.
it's escalating fast. And I feel like that's again, we're talking about 2026 and moving forward. So a lot of markets right now are extremely oversaturated. And it's this low because the two biggest threats being cities and HOAs that are flat out banning or restricting
Yeah.
STRs. It's too many operators that are flooding the scene into these massive, the major tourist zip codes. Both are accelerating, they're not really stabilizing. So adding in STR specific financing that often carries its own rate premiums on top of an already elevated base
Yeah.
rate
That's a
is a
good point.
huge downside risk that's just compounding. And that upside is getting squeezed out by competitors that you
Yeah.
often can't
And
play with in those big zip
I've heard
codes.
it's good for a pure income standpoint, but you better really know your location when you go to do it.
It's really based off of location. And
Yeah,
I
that's
feel
especially
like
true in
a
southern
lot of
Rhode
it's
Island for
luck
sure.
because a lot of these places, when they bought it, that financing was so different than it is today. Home values
Yeah.
so different than they are today. Where if you
Yeah.
even think of looking at one of these properties today that are worth 1 million, 2 million, three
It's a good
million,
point.
forget
It's a good
about it.
point.
The amount of
Yep.
money you're going to have to charge, you're going to need to have that sort of summertime, allocated amount of money coming in from renting it during that summertime phase, having it all year round, which is unrealistic. So,
Yeah.
you know,
And you're
you
also competing with people that are shopping you on Airbnb as well. They're looking at the units in the
yeah.
neighborhood to see what amenities they have. You're going to end up in a race where if your house isn't enough alone to stand out,
Hmm.
you're going to have to start adding in amenities, which incur more costs. Maybe a hot tub, maybe other things, a pool maintenance. There's going to be a lot more moving parts to it. There's certainly a
Right.
lot more in terms of cleaning fees and turnover and active management. Not to mention management fees are going to be
Oh my gosh, I
significantly
know.
higher versus a long term rental. Yeah,
Correct.
there's one more left. This is kind of, in my opinion, this is a long term play. This is once
Is
you've
a
already
very
made
passive play.
made a name for yourself, so to speak, in the real estate game, or a significant amount of portfolio accumulated. I'm going to put it in B tier. I'm going to explain what it is. It's REIT. A REIT is a
Hmm.
real estate investment trust. It is having a piece of the pie in a company that runs real estate as a business. So real estate as a business, meaning they own a certain amount of homes, units, portfolios, doors, whatever you want to call it, scattered. It could be throughout the country. But what it does is it gives you access to a piece of the pie in terms of the total revenue and risk. So it spreads your risk out across a large portfolio. Like I said, it could be all over the country, but it also gives you, let's say 1%, it gives you 1% of the rental income of many different pies around a
Hmm.
portfolio versus just putting all your eggs in one basket. So really, it's just a tool to diversify towards the end of your real estate investment journey. It's a really great way to still be involved in real estate, but not have to be involved in the active, if a pipe breaks or
Right. Right.
tenants, termites, and whatever else,
Yeah, I think that blends perfectly into what I think, again, are the pros and the cons, and why I slotted this at B tier personally, is starting
Yeah,
off with the pros, you're getting zero landlord headaches, okay? And that's, for some people, that puts it in S tier.
priceless.
It's
Yeah,
priceless, right?
yeah.
It's also purely passive exposure to
Hmm.
real estate, which is, again, putting it into S tier for someone. It's
Yeah,
liquid, again, argument to put it in S tier. You can sell the same day, unlike physical property, which can be an absolute headache. And another good reason why I think it is where it's at is that low capital barrier, depending on which kind of REIT you're getting into. Generally
yeah.
speaking, you'll be able to find one where there's a low capital barrier. But then
Hmm.
again, lower the capital, lower the return. So it's one of
Yeah,
those balances that, the more you put in, depending on how well it does, the more you get out. And then again, going off what Zach said, with the diversification aspect across many properties and markets, if one market's doing poorly, the next four or five that you're invested into minority stake is, could be doing a lot better. So
could make
it's
up for it. Yeah.
right where I think it drags it into the cons is you don't control anything, and control in business, especially in real estate portfolios, is important. There's no forced appreciation. There's no leverage you control, no tax benefits like depreciation passing to you personally. It's correlated with stock market volatility more than local real estate cycles. The dividend
Yep.
yields get less attractive when the bond yields are elevated. And so
Hmm.
you're sort of competing for the same yield seeking capital right now. Um,
Yeah.
so those things for me just drag it too low. And again, I think you nailed it perfectly on the head, Zach. It's something that's not going to be, in my opinion, your main capital earner. It's going to be something that you probably look
Yeah.
into later in life, or something
Uh-huh.
that's earning you simultaneously with these other
It's
set of things that you're doing.
Yeah. One thing to mention as well, you're pretty much avoiding almost all risk unless the entire portfolio collapses, which is
Right.
pretty
Highly unlikely to
rare
happen.
if you're in a large enough company, part of a large enough company. But your income that you receive from a REIT is going to be taxed differently than just rental income. You don't have the same ability to write off as much as you do
Right.
if you are an owner, direct owner running a property through management, because you can't actually depreciate the physical asset. You're just a part of a company. So that is
Hmm.
one thing to keep in mind. But for some, it is the ultimate hands off return. If you really trust the people you're with, and it can be very lucrative if it's a private investment, because a lot of times private investors may have properties that have been inherited over multiple generations and
Hmm.
are unattainable for the public, that
Right.
just provide a cap rate that nothing else can really compete with. So there are
Yeah.
use cases for it. But yeah, it is definitely something that is later on as more of a diversification play.
My next question for you, Zach, before we end off here,
Yep.
is any last minute changes looking at our list here? I think I see one, but I want to hear from you
Let
first
me
if there's anything
think.
you would change. And if you like it, you like it.
I personally might move the Burr method up a little bit, just
Mm.
because like I just said, I think the top end of the spectrum here is going to be more for wealth building rapidly, and that's kind of what that favors. But there is a
But
good
it's
deal of
so
risk
market
there.
dependent. I feel like B is literally the definition of perfection for
Yeah,
this, because if those rates start to tilt this way, we start to tilt upwards in the scale. If they start to tip the opposite way,
true,
you
true.
start to tip. I feel like it's perfect. No matter how you boil it down, though, the Burr method gets replaced with something like a fix and flip or a buy and hold, in general. So I don't know. I'm tempted to leave it, but I would I
You can
you could
kind of
argue to
mitigate a
me,
lot of.
A tier. You could. I could believe that. But
Okay, what were you
I
thinking?
like where it's at. Dropping seller financing to A. And the reason
Okay,
is as amazing as it is, it's really the repeatability of it. I mean, we have dug into seller financing quite a bit,
Yeah,
and I think
yeah.
that you need to start building a team of originators on that.
I'll
And
agree with you on that.
if
High
you were
learning curve, high
right,
skill gap.
if you're gonna repeat this, that's where I think that skill gap really hits, and where you need originators finding
Yeah,
you
I think you're
deals.
kind of
You know,
I think you're kind of bundling wholesaling and seller financing together in the same vein there,
yeah,
and trying to put an umbrella over the whole creative financing thing as a whole.
yeah.
I agree with what
That's
you're
my one
saying.
change there for sure. Everything else,
Yeah.
you could argue up and down, maybe one tier for each. REITs could probably hit C tier or A tier for me. Uh, BRRRR, like you said, could go up to A tier for me. I don't think it would go below B, but I think
I'm
this
gonna
list is
move
pretty
Burr up
good.
one just because
Ah,
it's my one of my personal favorites.
all right, fair enough, fair enough. I'll let it happen. Alrighty, well, I think that does it, guys. So check out leadmaxer.com. Also, guys, if you are posting sales content online, please hashtag leadmaxer so we can react to it. And then join our Discord where we bring in experts from all different types and scopes of work regarding real estate, regarding business development, all of that stuff. And again, if you guys want to pop in, tell us about your story, tell us about your life, we'd be happy to bring you, a group of people that want to hear more about you, learn, and all that fun stuff. So, I think that's good, man. We'll wrap it up there, and we'll see you guys in the next one.